Google is about to spend $200 billion in a single year, and the market hated it. The shares fell. But sitting in the same report is a number almost nobody led with $514 billion of cloud backlog, revenue that customers have already signed contracts to pay. That is more than 5 years of cloud revenue at the current run rate, already committed, and it completely changes what the spending actually means. Before we start, the usual and important housekeeping. I am not a financial advisor. This video is for education and entertainment only. Nothing here is investment, tax, or legal advice. And nothing here is a recommendation to buy or sell any security. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research. Welcome back to The Silent Investor, where we go deep. In the last video, we took Alphabet's second quarter apart and found that the spectacular $9.11 of earnings per share was mostly an unrealized accounting gain, and that the real operating number was $2.85. This video is the other half of the story. It is the bull case for the business underneath, and it rests almost entirely on one number that most coverage mentioned in passing and then moved on from. Let us start with the strongest version of the argument against, because a bull case that has not survived it is worthless. The bear case is this: Alphabet is spending money at a rate that has never been seen before on infrastructure whose returns are unproven, in an industry where everyone is building simultaneously. Capital expenditure guidance keeps rising. Free cash flow has gone negative. Depreciation from all that equipment will weigh on margins for years. And artificial intelligence may eventually erode the search advertising business that pays for everything. That is a coherent, serious case. The answer starts with a term that sounds like jargon and is not: backlog. In cloud accounting, it is usually called remaining performance obligations, and it means revenue that a customer has contractually committed to pay, but which has not yet been delivered or recognized. It is not a forecast. It is not a pipeline. It is not management optimism. It is signed contracts. That distinction is the entire reason the number matters. Alphabet's cloud backlog reached $514 billion. To understand the scale, compare it to the revenue that business is currently producing. Google Cloud did $24.8 billion in the quarter. Annualize that, and you get roughly $99 billion a year. So the backlog is a little over 5 times the entire current annual revenue of the division already under contract. Most companies would consider 1 year of coverage healthy. And here is why that changes the argument rather than just decorating it. The bear case rests on the word speculative. Alphabet is spending $200 billion on capacity that might not be needed. But if customers have already signed for $514 billion of future services, then building the capacity to deliver them is not speculation. It is closer to filling an order book. The spending is still enormous, still risky on timing, and still real. But the framing shifts from a gamble on demand to a race to serve demand that has already been contracted. Let us put rough numbers on it and be clear these are illustrative rather than guidance. Suppose that backlog converts to revenue over something like 4 to 5 years, which is a typical range for large enterprise cloud agreements. That implies somewhere around $100 to $130 billion of contracted cloud revenue arriving each year, on top of whatever new business gets signed, against annual capital expenditure of roughly $200 billion. That starts to look less like a leap of faith and more like a financing question. Timing is the risk, not demand. The second pillar is the growth rate, and specifically its direction. Google Cloud grew 48% in the fourth quarter of last year, 63% in the first quarter of this year, 82% in this one. Growth rates normally decay as a business gets bigger because each additional percentage point requires more absolute revenue than the last. This one is doing the opposite at a scale of nearly $100 billion a year. That is genuinely rare. Third, and this is what separates it from growth bought with discounts. Cloud operating income roughly tripled from $2.8 billion to $8.81 billion. Divide that by cloud revenue of $24.8 billion, and you get an operating margin of about 35.5%. An infrastructure business approaching software style margins while accelerating. Growth and margin expansion usually trade against each other. Getting both at once is the signature of real operating leverage. Fourth, the thing that funds all of it did not crack. The single biggest fear about Alphabet for 2 years has been that artificial intelligence answers would eat search advertising. Search and other revenue grew 17% to $63.3 billion. Google services overall grew 15% to $94.5 billion. YouTube advertising rose 13% to $11.1 billion, ahead of expectations. The cannibalization thesis has not shown up in the numbers yet. Yet is doing real work in that sentence, but so far the engine is running. Fifth, distribution, which is the most underrated advantage in technology. The Gemini application has roughly 950 million monthly active users. Alphabet's models are processing on the order of 22 billion tokens a minute through its interfaces. Around 90% of the Fortune 100 are using Gemini Enterprise in some form. Building a capable model is difficult and getting harder to differentiate. Having somewhere to put it in front of billions of people already is not something a competitor can simply spend money to replicate. Sixth, and this one is structural. Alphabet designs its own artificial intelligence chips, the tensor processing units, and has done for a decade. Every other major cloud provider is substantially dependent on buying accelerators from NVIDIA at NVIDIA's margins. When you are spending $200 billion a year on infrastructure, owning a credible in-house alternative is not a rounding error. It is a permanent cost advantage on the single largest line item in the budget, and it compounds for as long as the build-out continues. And there is a seventh point which the last video treated as accounting noise and which deserves a fairer hearing here. That $99 billion gain was unrealized and it absolutely should be stripped out of earnings. But the stakes producing it are real assets. Alphabet holds significant positions in private companies, and those positions have been revalued sharply upward. As earnings, it is meaningless. As an asset on the balance sheet that could one day be realized, it is not nothing. Ignore it in the profit line. Do not pretend it does not exist. Now, the discipline. Backlog is strong evidence and it is routinely overstated, so let us be precise about its limits. It tells you demand exists, it does not tell you when. Large enterprise contracts run for years, and a very large number can convert slowly. Some agreements contain terms allowing renegotiation or cancellation, and a backlog concentrated among a handful of enormous customers carries very different risk from one spread across thousands. Treat 514 billion as high confidence about direction and low confidence about dates. And several parts of the bear case survive all of this intact. Free cash flow was negative $5.9 billion, and Alphabet raised roughly 70 billion in fresh capital during the quarter. The depreciation from 200 billion of spending will press on margins for years, regardless of how good the backlog looks. Guidance has been raised repeatedly, and management has already signaled next year will be higher again. Regulatory pressure has not gone away. And the entire industry is building at once, which means the risk is not that Alphabet is wrong about demand. It is that everyone is right about demand and collectively wrong about how much capacity it needs. So here is the falsifiable version, which is what a thesis should always come down to. 1. Cloud growth has to stay strong. Not 82% forever, but it cannot fall off a cliff. 2. Cloud operating margin has to hold or expand because growth bought by cutting price is a different business from growth that arrives with margin. 3. Backlog has to keep building while it converts, not simply drain. 4. Search has to keep growing through the transition to answer style results. If those four hold, the capital expenditure is a bridge to a much larger business. If two or more break, the bears were right and the spending was early. And there is a transferable lesson here that outlives this quarter. When a company is spending heavily and the market is nervous, the useful question is never how much are they spending. It is what evidence exists that the spending is demanded rather than hoped for. In cloud software, that evidence is backlog and remaining performance obligations. In manufacturing, it is order books. In pharmaceuticals, it is trial data. Whatever the industry, find the number that represents a commitment somebody else has made and weigh it against the number the company is choosing to spend. So the takeaway, Alphabet's cloud division is accelerating at scale, expanding margin while it does so, and carries $514 billion of contracted future revenue behind it. The advertising engine that funds everything is still growing. It owns its own chips and it owns distribution that money cannot easily buy. Against that sits genuinely negative free cash flow, a rising bill, and a depreciation wave that has not arrived yet. The bull case is not that there is no risk. It is that the risk is about timing and the demand is already signed. And one closing thought that applies to both of the companies we have looked at this week: the market sold both of them for spending money. That is worth noticing because it is a strange thing for markets to punish when the spending is being made by companies with the balance sheets to afford it, and in Alphabet's case, an order book to justify it. Sometimes an entire market decides that investment is a cost rather than an investment. Whether that judgment turns out to be right is exactly the sort of thing you only get to find out slowly. If this gave you a better way to judge heavy spending, do me one small favor. Tap like. It genuinely helps more investors find this. Share it with someone who only saw the capital expenditure headline, and subscribe because we do this properly every week. We do the digging so you do not have to guess. See you in the next one.